As we ring in the new year and roll into quarter one of 2025, we're starting to see numbers and narratives come together. I expect to see the continuation of a few trends in 2026. However, we can also expect the market to have a few shakeups as well. After speaking with some of the industry's top voices in 2025, a lot of our listeners reached out wanting to hear directly from our team and get a better feel for what's going on in the market. After conversations with corporate occupiers, developers, and lenders, and more than 100 transactions closed across the past year, here's what I'm actually seeing in the marketplace. I'm going to go over asset by asset and location by location in greater Chicagoland to provide an idea of where opportunities exist in the market, as well as critical locations to avoid. So let's dive into it. The commercial real estate market in Chicagoland is sending mixed but increasingly interpretable signs. The extreme dislocations of the early 2020s are giving way to a more stable pattern, one where different asset classes aren't just diverging, but defining their long-term roles in the region's economic ecosystem. Office is stabilizing in pockets, industrial is recalibrating after years of drought-level vacancy, multifamily is absorbing supply while holding pricing power, and redevelopment continues to be the bridge that's connecting all the asset classes across the board. In quarter one of 2026, the office conversation in Chicagoland has meaningfully evolved from the early 2020s. The panic phase is over. What we're in now is a sorting phase, one less defined by headlines and more fundamentally about lease term structures, tenant credit, building systems, power capacity, and the feasibility of alternative uses. Let's start with the headline numbers and then put them into context. Downtown Chicago office vacancy is hovering around 26 to 27%, depending on the methodology used. And that's still historically elevated, but the important shift is directional. Net absorption has stabilized in the second half of 2025. And while it wasn't strongly positive, the pace of givebacks have slowed materially. The market is no longer hemorrhaging space each quarter, and that matters, particularly for underwriting, refinancing, and tenant decision making. Sublease availability downtown has also plateaued. At its peak, sublease space represented nearly 30% of all available downtown inventory. As of early 2026, that figure has begun to compress as sublease terms burn off and occupiers make long-term decisions about hybrid office space. Many firms that overcorrected in 2023-2024 are now leasing again. It's a very different market than pre-2020. One of the biggest stabilizers in 2026 is the clarity around hybrid work. Most professional services firms, tech adjacent, and corporate headquarters have landed on a 2 to 3 day per week pattern. That predictability has allowed tenants to right size intelligently rather than defensively. So, what does that mean for the market? Well, most importantly, it means fewer emergency terminations and panic. As a result, we're beginning to see data indicating more lease and footprint stabilization. However, as I mentioned earlier, the space being leased is very different from 2020. We are seeing a bifurcation of the marketplace. Either companies are seeking flexibility with plug and play spaces or 7 to 10-year leases with premium buildouts. Therefore, as we discussed last quarter, Class A building options continue to outperform in the marketplace, both on occupancy and stability of long-term leases. As a result, in 2026, office performance is no longer cyclical, as much as it is structural. Class A and A-plus office buildings downtown and in Fulton Market are operating in a different universe. These assets typically share 5 characteristics. 1, modern HVAC and electrical systems. 2, strong natural light and efficient floor plates. 3, ample amenities. Fourth, transit access. And fifth, ownership that's willing and able to invest in capital improvements. Therefore, these buildings are still transacting and leasing in a mid 40s downtown range, higher in Fulton Market, with concessions moderating compared to 2024. Tenant improvement allowances still remain elevated, but landlords are protecting face rents and focusing on credit quality. Class B buildings, by contrast, are increasingly bifurcated themselves. Those with good bones, reasonable column spacing, and manageable cores are competing by offering value, flexibility, and speed. Others are slipping into long term limbo with rising vacancy and limited capital investment. Class C office is now widely understood by the market, especially investors, as transitional inventory. Its value is no longer in leasing, but in optionality. Investors are looking at zoning flexibility, land value, and conversion feasibility. One of the most important Q1 2026 developments is that office to residential conversions have become more selective, and as a result, far more realistic. Early enthusiasm has given way to reality. Today, only a narrow band of buildings truly work for effective conversions. Buildings must have narrow floor plates, logical window spacing, central cores that allow for multifamily layouts, and an acquisition basis below replacement cost. Additional incentives are often needed, including zoning flexibility and access to transportation. The LaSalle Street corridor remains a prime example of this, with 1,700 residential units either delivered under construction or approved through the LaSalle Street program, including meaningful affordable housing. But what's changed in Chicago in particular, and amongst its capital partners, is investors are no longer trying to convert everything. They are converting what pencils. This has led to a stabilizing effect in the broader office market. The O'Hare office market continues to outperform the broader metro area, with vacancy generally tracking in the 18 to 20% range. Again, not strong by historical standards, but resilient relative to other areas in Chicagoland. Why? Well, infrastructure and use alignment. O'Hare adjacent office benefits from proximity to logistics, aviation, and global business. Class A rents near O'Hare remain in the 30s gross, and leasing activity has picked up modestly as corporate travel normalizes and international connectivity improves. Importantly, these tenants often value location consistency over rent minimization, which supports longer lease terms. Class B and C buildings near O'Hare still face many of the same pressures that they do in other places in the market and are now being underwritten as flex, industrial, or mixed use sites rather than pure office plays. Suburban office vacancy in early 2026 sits near 27 to 28%, roughly in line with downtown, but the underlying drivers are different. Strong suburban nodes like Oak Park and parts of Schaumburg, as well as desirable Lake County locations, continue to lease. These markets benefit from the office campus style environment, retail, dining adjacency, easier parking, and lower total occupancy costs than downtown office. Oak Brook, in particular, continues to post upper 20s gross for rents, with Class A vacancy materially below the suburban average. Landlords who invested in amenities, outdoor space, and flexible layouts are being rewarded. Conversely, older suburban campuses with deep floor plates, low ceiling heights, and minimal reinvestment are increasingly being repositioned or quietly removed from the office inventory. For occupiers, office is no longer a rushed decision. You have leverage, optionality, and time, but building quality matters more than ever before, and signing long term with a building without a clear future strategy carries significant risk. For investors, office in 2026 is not about betting on a full rebound. It's either about owning office assets at the top of the quality stack or buying at a basis that reflects today's reality and then creating value through reinvestment or conversion. As a result, office isn't dead in Chicago, but many markets are readjusting to the new area's financial and physical changes. Therefore, there's a tremendous amount of opportunity for both occupiers and investors. As we move into quarter one of 2026, the industrial market in Chicagoland is no longer defined by the extreme tightness we saw coming out of the pandemic, but it's also not rolling over. What we're seeing instead is normalization, and importantly, that normalization is happening unevenly, depending on location, building type, and infrastructure. So let's start with the numbers, and then let's talk about what those numbers actually mean. Across Chicago's metro area, total industrial inventory now stands at roughly 1.4 billion square feet, the largest industrial base in the country. Vacancy in quarter one 2026 is running between 5.8 and 6.2%, depending on how sublease space is categorized. That's up from historic lows of roughly 3.4% in 2021, but still well below the average long term, which typically sits around 7 to 8%. So, despite the narrative that industrial is cooling, the data tells us something much more precise. This is not an oversupplied market. This is a market that has moved from scarcity driven panic to fundamentals driven decision making. Net absorption across Chicagoland has slowed meaningfully through 2024 and early 2025, particularly in large format logistics buildings, which were delivered during the peak e commerce boom in the 2020s. But what's important is in quarter one of 2026, that absorption has stabilized and has not continued to deteriorate. So, what are we seeing right now? Well, we're seeing positive absorption in small to mid bay industrial, manufacturing, and life science and cold storage adjacent spaces, particularly in infill submarkets. However, what's important is absorption has been strong in some areas. In areas over 500,000 square feet, particularly speculative development, those locations have struggled and are substantially below the market in both occupancy rate and rents. So, in quarter one of 2026, it's no longer a take anything you can get market. Users are being selective, and buildings, as a result, that don't line up with how companies are actually operating in today's market are being left behind. Another misconception worth clearing up is rent growth. Industrial rent growth has undeniably slowed, particularly in metro areas that were speculative. Rent growth now averages around 3% a year compared to the double digit increases we saw in 2021 and 2022. But importantly, rents are not broadly declining. What we're seeing is face rents largely holding, concessions increasing modestly, particularly in softer submarkets, and concessions tightening again in infill locations. In other words, landlords are defending rate integrity while using structure and not discounts to close deals. That's a sign of a healthy late cycle market, not distress. One of the biggest challenges entering 2026 is on the supply side. Industrial deliveries in Chicagoland peaked in 2023. Since then, new deliveries have fallen by more than 30%, and speculative starts have slowed dramatically. Most new construction today is either built to suit or meaningfully pre leased. That matters, especially because it removes some of the fears of a runaway oversupplied market. The pipeline is shrinking at the same time that demand is stabilizing, which provides a natural floor for vacancy and rents. Now, let's talk about where the market is still exceptionally tight. Elk Grove Village remains one of the country's most constrained industrial submarkets. Vacancy in Elk Grove Village is still hovering around 1 to 2% in quarter one of 2026, and there is effectively no greenfield land. Turnover is driven almost entirely by functionally obsolete product rather than new supply. This is not cyclical tightness, this is structural scarcity. The O'Hare corridor tells a very similar story, with vacancy generally around 3 to 4%, and demand here continues to be driven by freight forwarders, aviation adjacent users, cold storage, and power intensive operations. This brings us to one of the most important industrial themes of 2026. In quarter one of 2026, power availability is no longer a secondary consideration, it's a gating factor. We're increasingly seeing deals delayed or killed entirely because buildings cannot support automation heavy operations, cold storage, refrigeration loads, advanced manufacturing processes, or data supported logistics systems. Utility upgrade timelines are often 18 to 24 months, which does not align with most lease timelines. As a result, buildings with scalable power capacity are leasing faster and commanding stronger terms, even within the same submarket. This is creating a real cap rate divergence based on infrastructure, not just location. Yes, large format logistics buildings in peripheral submarkets are softer in quarter one. Vacancy in some of these corridors is pushing 8 to 10% or higher, with sublease availability increasing and lease up timelines lengthening. But here's the key point: that softness is localized. It's not spread into infill markets, mid bay product, or power capable facilities. And because of the construction pipeline that is slowed, this softness is not compounding. Lake County continues to stand out in quarter one of 2026, not because it's the tightest market, but because it's one of the most executable. Since 2021, the county has attracted more than 1.7 billion in industrial and life science investment, creating and retaining thousands of jobs. Vacancy here is higher than Elk Grove, but absorption remains steady and development is largely demand driven. Tenants are choosing Lake County in particular as an intentional spot to locate, particularly around life science and I-94's corridors, because of lower land costs and strong life science and manufacturing ecosystems. That's a very different demand profile than spillover logistics, and it positions the county well for the next cycle. So, what does all this mean? Well, industrial in 2026 is no longer about chasing growth at any cost. It's about alignment. It's about aligning businesses with buildings that have labor access, power flexibility, and are generally as a result outperforming the market. Buildings that don't are falling behind, regardless of age or class. For occupiers, this is a healthier market. You have more time, more leverage, and more choice, but only if you're flexible on location, cost, or size. For investors, industrial remains the strongest asset class in commercial real estate. But the easy money is gone. Returns now come from precision, not market momentum. And as a result, increasingly that precision is pushing capital towards infill redevelopment and assets that sit at the intersection of industrial, infrastructure, and land. That's the industrial story in quarter one of 2026, and it's far more nuanced and far more durable than the headlines suggest. As we move into quarter one of 2026, multifamily continues to be one of the steadiest asset classes in the Chicagoland market, but not without nuance. This is no longer the rent spike environment of 2021 or the anxiety driven construction boom of 2023. What we're seeing now is a market that is absorbing supply, balancing itself and laying the groundwork for a firmer, fundamentally driven market. So, let's start, as always, with the data. Across the Chicago metro area, on average, effective rents ended up around 4% last year, even after modest softening in the second half of the year. In the city of Chicago specifically, median rents are sitting in the low 1800s, down slightly month over month, but still well above pre pandemic levels. Importantly, occupancy across professionally managed properties remains healthy, generally in the 93 to 95% range, depending on submarket and asset class. That combination of moderate rent growth with strong occupancy is the hallmark of a market digesting new supply rather than losing demand. One of the most important multifamily developments entering quarter one of 2026 is what's happening on the supply side. Nationally, in 2024, it was a year for multifamily deliveries. Chicago participated in that wave, even if more muted than the Sun Belt, particularly in the downtown and near downtown submarkets. But as we enter 2026, the pipeline is thinning. New starts are down materially, and projects for 2026 and 2027 delivery are roughly 20 to 25% lower than peak levels. That matters because multifamily is fundamentally a lagging asset class. The project deliveries today were underwritten 2 to 3 years ago and under very different capital market circumstances. As that supply burns off and fewer projects follow behind it, the market naturally tightens. Downtown multifamily in quarter one 2026 is best described as stable. Yes, there's still competition among Class A buildings. Yes, concessions remain part of the conversation. But occupancy is held and, in many cases, improved as office to residential conversions begin, and we're beginning to see product come on the market. The LaSalle Street corridor is a strong example of that, with more than 1,700 residential units delivered or under construction or approved as part of the office conversions plan. These projects are not flooding the market. They are targeted, mixed income, and largely replacing obsolete office stock rather than adding speculative density. From a market perspective, that's constructive. It increases downtown population, supports retail and services, and creates a more balanced live work ecosystem. And importantly, it removes stranded office inventory while adding housing that the city still needs. Outside of the CBD, multifamily fundamentals are even more resilient. Neighborhood submarkets with transit access, retail adjacency, and strong school districts continue to see solid demand. Suburban multifamily, particularly in Lake County and north and northwest suburbs, remain undersupplied relative to household formation and household downsizing demand. We're seeing a steady increase in leasing demand that's being driven by empty nesters downsizing out of single family homes, young professionals being priced out of the market for homes, and renters prioritizing flexibility over long term mortgage commitments. In quarter one of 2026, multifamily rent growth is no longer accelerating, but it's also not reversing. Across most submarkets, effective rents are growing at around 2 to 3%, with some softness in luxury downtown product and stronger performances in well located suburban and neighborhood assets. What's notable is that concessions, while present in the market, are being used tactically rather than aggressively. Free rent is often limited to lease up situations, and renewals, although sometimes seeing free rent given, it's much more rare than the market as a whole. That tells you that although We are seeing pricing softness. As a whole, it's still a relatively robust marketplace. From an investment standpoint, multifamily capital in Q1 2026 is cautious but active. Lenders are underwriting conservatively, focusing on in place cash flows, realistic expense assumptions, lower leverage, and strong sponsorship. Therefore, even as transaction volume is not back to peak levels, deals that pencil are trading, particularly when properties have stable occupancy, limited near term capex, and exposure to long term supply constraints. Importantly, multifamily is still benefiting from its relatively strong position. Compared to office, it carries less structural risk, and compared to industrial, it offers more predictable cash flow. So, where does that leave us? Well, multifamily in Q1 2026 is not a story of explosive upside, but it is a story of durability. Supply is cresting, demand remains intact, rent growth is moderating, but positive, and development discipline is returning to the market. For occupiers, that means more choice in the near term, but likely firmer pricing over the next few years as construction slows. For investors, this is a positioning phase. You're not buying at peak rents, but you're also not buying into distress. The opportunity lies in well located assets that can ride the next tightening cycle as supply constraints reassert themselves. And when you zoom out, multifamily continues to be a strong play, and particularly a strong play in Chicagoland as the broader real estate ecosystem absorbs population stabilization and acts as a natural reuse path for obsolete office. Next up, we'll talk about one of the least glamorous but most misunderstood corners of the market: industrial outdoor storage, and why the data shows that it has quietly become one of the most valuable land uses in the region. Now, let's move into one of the least talked about and most misunderstood asset classes in commercial real estate: industrial outdoor storage, or IOS. This is not a glamorous sector of the market. There are no polished lobbies, no Class A amenities, no architectural awards. But if you want to understand where real estate scarcity exists in Chicagoland, Q1 2026, iOS is one of the clearest examples. And once again, the data tells a very consistent story. At a national level, iOS is now estimated to represent roughly $200 billion in asset value, a figure that has grown rapidly since 2020, as institutional capital finally began underwriting in the asset class. Vacancy in iOS typically runs at half or less than half of traditional warehouse vacancy in many major metro areas, particularly Chicagoland. Functional vacancy in Chicago is around 2%, and in certain corridors, it's effectively zero. Rents have also outperformed bulk warehouse space over the past 5 years. While warehouse rents have generally moderated and stabilized into the low single digits, iOS rents in infill locations have continued to post mid to high single digit rent growth. Overall, the market is being driven by one thing: scarcity. The reason iOS performs the way it does is structural scarcity. It's not cyclical. You can always build another warehouse on the edge of a metro area. You cannot easily create new legal truck yards, so therefore iOS faces three permanent constraints. First, zoning resistance. Municipalities strongly disfavor new iOS. Second, community opposition. Truck traffic, noise, and visual impact limit approvals. And third, municipalities push for competing land uses and towards higher perceived tax uses. As a result, once a site is paved, fenced, and legally entitled for outdoor storage, it becomes functionally irreplaceable, especially in infill locations. That's why iOS behaves more like infrastructure than traditional real estate. In Chicagoland, iOS performance closely mirrors industrial infill dynamics, but with even tighter constraints. Around O'Hare and Elk Grove Village, industrial vacancy is already under 2%. iOS availability in those same corridors is even tighter. Most legal yards are fully occupied, often by long term tenants with specialized operational needs. Demand here comes from freight forwarders, trucking, construction, equipment rental companies, utility companies, and municipal contractors. These tenants tend not to be optional but highly location dependent. One of the defining characteristics of iOS tenants is stickiness. Relocation for an iOS operation is operationally complex and expensive. It involves new zoning approvals, re-permitting, security redesign, fleet logistics changes, and labor displacement. Because of that, iOS renewal probabilities are materially higher than traditional industrial. In practice, many iOS tenants stay put 10 to 20 years or even longer, renewing multiple times at escalating rental rates. That is why iOS cap rates have compressed relative to warehouse over the last several years, despite the asset class appearing simpler on the surface. For decades, iOS was dominated by small operators and local owners. That changed in 2020. Institutional capital entered iOS for three data driven reasons. First, low capex requirements. Second, high renewal probability. And third, minimal asset class obsolescence. Once paved and entitled, iOS does not face the same functional depreciation as other, more building centric assets. There are limited clear height restriction issues, minimal HVAC systems issues, very limited office build out issues, and as a result, from a risk adjusted standpoint, iOS is extremely attractive in a higher rate environment. Moving north into Lake County, the iOS story changes slightly, but not fundamentally. There are more land plays here, and in certain municipalities, there's marginally more willingness to entitle iOS. But even there, infill sites towards the tollway with proper truck geometry are hard to find. The data shows that even in markets with more land, iOS availability still collapses rapidly once zoning and access constraints are applied. In other words, scarcity still wins. For investors, iOS is one of the cleanest expressions of supply constrained real estate in the market. So, as a result, returns are driven by land scarcity, zoning barriers, tenant immobility, and long term demand, tied particularly to logistics and construction trends. It's not a growth story in the traditional sense, it's a durability story. And as a result, the data supports that durability across cycles. For occupiers, iOS is one of the toughest markets to navigate. If you need a yard, you cannot wait until lease expiration. You cannot assume relocation is feasible. You cannot rely on speculative supply. You have to plan ahead. You have to lock down space decisively and often overpay for it. The data shows that once you lose a well located iOS site, replacing it is often impossible, especially within the same trade area. That's why renewals are high and pricing power sits firmly with landlords. iOS helps explain what's happening elsewhere in the market. As obsolete office and retail assets come under pressure, many assume they will just convert to industrial or iOS. The reality is that most will not. iOS is not easy to entitle, it's not politically popular, and it only works in very specific locations. That's why existing iOS assets continue to command premiums and why the market keeps repricing them upward. Now let's talk about land and redevelopment. because this is where everything that we've been talking about already comes together. So, when we're talking about land and redevelopment, it's important to understand that it's the most effective mechanism generally through which capital is reallocated when commercial real estate falls out of alignment with the market. So, in quarter one of 2026, that mechanism is working, and it's working quite effectively. Not aggressively, not recklessly, but deliberately. And that distinction matters. Over the past 3 years, redevelopment activity slowed for one simple reason: uncertainty. Construction costs were volatile, interest rates reset faster than underwriting models could adjust to, municipal approval timelines became riskier as a result, even though political pressure was mounting around housing, traffic, and land use. As a result, many owners and developers waited. So, what's changed entering 2026? It's not necessarily optimism, but it's clarity. We now have a generally stabilized interest rate expectation, more predictable construction pricing, clear municipal priorities in Chicagoland around housing and employment, and increasingly a view of what is obsolete in terms of assets. And that clarity allows for redevelopment math to math again. So let's anchor this in the data. Across Chicagoland, tens of millions of square feet of office and retail inventory are now functionally obsolete. The inventory is not necessarily obsolete because they're vacant. They're obsolete and the spaces are obsolete because the user requirements are no longer wanted in the market. And in office alone, downtown vacancy that remains around 26% to 28% in some portions of the market sits in older, predominantly inefficient buildings. And these assets are not going to lease their way back to health. The data on that absorption, rent growth, and tenant preferences makes that clear. So, what does this mean? The value is no longer driven by income for many of these properties, it's driven by what the land can become. One of the biggest misconceptions about redevelopment is that the goal is always to push the land into the most intensive use possible. And although that's perceived as a high value move, such as putting dense logistics or high dense residential into a location, that's rarely how successful projects actually get built. In quarter one of 2026, the data shows that most of the successful redevelopment projects share three traits: one, community use compatibility; two, entitlement realism; and third, infrastructure alignment. That's why most office to industrial conversions fail, and most office to multifamily or office to flex succeed. The LaSalle Street corridor has already demonstrated what works: narrow floor plates, logical building cores, mixed income housing, and public private alignment. As a result, more than 1,700 units at LaSalle Street are either delivered, under construction, or approved through this program. And that's not because conversion is easy, but it's because these buildings met specific feasibility thresholds. So, what's changed in 2026 is discipline. The city is no longer entertaining marginal conversion proposals. Capital partners are underwriting conservatively, and developers, as a result, are targeting buildings where conversion improves, not dilutes the city's urban fabric. That selectivity reduces risk, and as a result, it improves execution timelines. Outside of the CBD, redevelopment looks different. In the suburbs, we're seeing office campuses being repositioned into multifamily, senior housing, or mixed use retail. We're also seeing mall conversions as well as office to industrial conversions. And generally, the most important thing about these conversions, like all of the conversion projects that we've been discussing, is to find uses that are consistent with the community as a whole. Unless there's community buy in, a project never makes sense. So, as we wrap up quarter one 2026 and the market update, I want to zoom out for a moment. Because when you look at each asset class in isolation, it's easy to miss the bigger signals. So, what the data shows us very clearly right now is Chicagoland's real estate market is not in collapse, it's not in chaos, it's a relocation. Office stopped falling and started sorting. The market is shedding obsolete inventory while stabilizing around buildings that still serve how people actually work. And that's not a failure of office, it's a recalibration to a smaller, more functional office footprint. Industrial is no longer riding a once in a generation shortage. It's operating in a more rational environment where infrastructure, power, location, they all matter more than sheer square footage. Scarcity still exists, but ultimately, it's not structural scarcity. Multifamily is doing what it almost always does in moments like this. It's absorbing supply, holding occupancy, and quietly reestablishing pricing power as new development slows. It's not exciting, but it's dependable. Industrial outdoor storage is a totally different world. It's reminding everyone what real scarcity actually looks like. Zoning entitlement and land constraints are driving value far more than building sophisticated buildings ever could. And the capital flowing into iOS is responding to that data and driving up costs. And redevelopment, whether it's office to residential, suburban campuses to mixed use, or obsolete assets to clean industrial. It's the connective tissue that's tying all of this together. It's how capital migrates from yesterday's demand into tomorrow's reality. What's different about Q1 2026 compared to the last few years is clarity. We have a much clearer picture on tenant behavior, clearer capital expectations, clearer municipal priorities, and clearer signals about what assets have a future and which don't. The clarity doesn't eliminate risk, but it does make risk priceable again. And when risk is priceable, deals get done. And for investors, this is not the moment to wait for a broad rebound. This is the moment to be selective, to focus on assets with infrastructure, alignment, and optionality, to underwrite reality, not nostalgia. The market in Q1 of 2026 isn't asking whether commercial real estate buildings will survive. That question has already been answered. What it's asking now is who wants to adapt. And as always, the data tells us exactly where to look. If you want more insights like this, grounded in real transactions, real negotiations, and real market data, subscribe to the Real Finds podcast. You can find us on YouTube, Spotify, or wherever you get your podcasts. I'm Gordon Lamphere with the Real Finds podcast, and thank you for listening.